It's a numbers game when you're drilling oil and gas, right? Some are a little better, some are a little worse. And it's a matter of timing when those come in.
Good morning. Thank you for joining Kolibri Global Energy's Q2 results with Adelaide Capital. Today, from the company with us are CEO Wolf Regener and CFO Gary Johnson. Kolibri Global Energy trades under the ticker symbol KEI on the TSX and KGEIF on the OTC. We will go through the Q2 numbers and then discuss how things are progressing operationally and how you foresee the rest of the year. I will turn it over to Wolf and Gary at this time, and congratulations on a good quarter, by the way. There will be time for Q&A after the initial discussion. Please enter your questions in the Q&A box, and this presentation may contain forward-looking statements.
Anyway, thank you everyone for joining us today. We released our 2023 earnings today, and I assume you've all had a chance to look those over. We're very pleased with what we've accomplished this quarter. We've had strong financial results, and we'll talk about the progress we've made on the infill development program and the early stages of proving up additional value for our shareholders. And I want to commend everyone in the company who's done a really good job in getting us to this stage. Once we're looking at the forward-looking information, the disclaimers, the non-GAAP measures, you can find these all on the website. It's basically the same slideshow that we have on the website. It's just a little rearranged, so you'll see the same slides here, with the exception of the ones that Gary will speak to, and those will all be verbally and recorded in the transcript as well. Just as a reminder, we have a large amount of proved reserves here, proved undeveloped, which makes us unique as compared to a lot of the other peers out there. And we're looking to develop those. Our production this last quarter is about 75% oil, the balance being natural gas liquids and natural gas. And as you can see where we came from, $6.5 million in EBITDA back in 2021, 25 million in 2022, and we're forecasting between 52 and 55 million. So we put in the average of 53.5 for 2023. Production second quarter, 2,400 BOE a day, just over that. And June 30th exit rate, we put down for 3,400 BOE a day. We did have about 300 BOE a day that was shut in. That's currently dewatering, or was still shut in from the offset fracks. Large reserve base, as everyone knows, I'm sure that's here, and a smaller market cap. So we have a long way to run. Sorry. Going forward here, what we accomplished, first downspacing in the field, the 6 wells per section in the Caney. We had 2 downspaced Caney wells that were drilled on one pad. It was the 8-1 and 8-2. One Caney had targeted the upper Caney and the other the lower Caney. Our well expectation was for this year was for 75% production rates of what the average 2022 well was. And obviously there are highs and lows in those rates, and we'll go into that a little bit here. We also had 1 T-zone well, which is the first T-zone well we've drilled in a long time. This was our first attempt to make an economic T-zone well using our latest completion techniques that we've been using and working so well in the Caney itself. The wells were drilled and completed, including facilities, for about $6.5 million. So that was less than what we had forecasted, which is nice in this day and age with everything going up pricing wise. So mainly efficiencies from the multiple pad drilling, and our guys doing a good job. So we increased our forecasted drilling program to 8 wells for the year. So we had the 3 wells that I just spoke about, the 8, 1, 2, and 3. On one pad. We're currently drilling 2 Caney wells, and then we'll move the drilling rig to drill another 3 pad immediately following. And that'll consist of 2 Caney wells and 1 T-zone well. Field, as you all know, but zooming into here a little bit, shows you where the 8, 1, 2, and 3 are. You can see the Caney wells are right here on the side. This was a lower Caney, this was an upper Caney, and then the 8-3 in the middle for the T-zone well. Where we're currently drilling is a section further to the west, in section 7, which is the Barnes 7 and the Barnes 7-4 and 7-5 wells, and those are both be in the lower Caney formation. 2022 wells, you can see the variability. They were all good wells, but we had wells that were IPing around 600 BOE a day and some that were IPing close to 1,000 BOE a day. And you can tell also most of them follow about the same decline rate, but every once in a while you get a well that really acts uniquely in the 16-3, the Glen. Suddenly had a much lower decline rate here for 3 months, which is great. So we'll see where that keeps going. Sure, it'll start following a more normal decline curve here at some point in time, but it's nice when wells outperform on that basis. So really variability in production out here in general in all fields. The Netherlands Sewell forecast was for about 75% of the 2022 average well that we drilled. And that's what that is. So you can see the variability in this. In our best, 75% of our best well would be up in the 700 BOE a day range, declining down. And our worst well was down here, which was still an excellent well, down in the 450 range or so. So when we look at this, we have this band that we're trying to keep in, right? So we'd expect some wells to be on the lower end, some wells on the higher end as we drill more and more wells through the field. The Barnes 2 and 3 wells were here in this band. The Upper Caney was a little below, and we'll see where it ends up. Hopefully it'll have a lower decline and get into the band here further out, but time will tell on that. So overall, really good results from our first set of downspacing wells. Very happy with the T-zone well that it's doing well, and we're hoping to that continues throughout the year. With that, I'll turn it over to Gary for the financial side of things, and then we'll have questions later on that we'll hopefully be able to get back to you on.
All right, thanks, Wolf, and thanks everyone for joining the call. You probably did see the earnings release that went out, but I'm just going to go over a few highlights for the quarter and also for the year-to-date June, and then we can take questions. So I'll start with the second quarter. Average production was up about 25% to 2415 compared to 1928 in the prior year. And as Wolf mentioned, the exit rate for the quarter was about 3,400. That excluded about 300 barrels that were shut in or being dewatered. Revenue was down about 19% to 10.1, and that was due to lower prices. Prices were down about 37% for the quarter, and that was partially offset by the higher production that I mentioned. Adjusted EBITDA was 7.6 million compared to 8.6 million, which was an 11% decrease, again due to the lower prices offset by the higher production. So we ended up with net income of about 4.3 million on earnings per share of 12 cents compared to 7 million or 20 cents in the prior year quarter. Moving on to our netbacks. Our netbacks were just under $40, which was down about 37% from the prior year. And again, that was in line with the price decrease. If you include the hedges in the netbacks, we're at 38.60. It was about 28% down from last year, which was 53.66. And then our net debt level at the end of the quarter was 16.8 million. Now moving on to the year-to-date, June year-to-date numbers. Average production was up 88% to just over 2,800 barrels compared to just under 1,500 barrels in the prior year. Net revenue was up 36% to 24.4 million. And that was due to the much higher production, partially offset by the price decline we had in the 6 months of 29%. So our adjusted EBITDA was up 67% to 19 million compared to 11.4 million. And again, that was due to the higher production offset by the lower prices. So we ended up with net income of 12.2 million with earnings per share of 34 cents compared to 4.6 million and 13 cents in the prior year 6 months. Netbacks were just over $42 compared to $58, which was a decrease of 28%, which is again was in line with the lower prices we experienced for the 6 months. And if you add the hedges in there, we're at 40.66 compared to 47.78, which was a decrease of about 15%. And I just wanted to mention, I think we said this in our press release as well, but we do expect revenue to increase in the second half of the year due to the 3 wells that just came out of production at the end of June, plus the 5 additional wells that will start producing during the second half of the year. So we expect to see an uptick. So that's all I wanted to cover. We can take questions, but I'll hand it back to Wolf.
Oh, oops. Sorry, I unmute. Everything is going really well. We're getting nice. Wow. We're getting nice improvements here, and but it's all going along with pretty much as we expected for the year. And we're looking forward to the second half of the year and continuing revenue growth and having everything keep going the way it is.
Okay, great. I mean, obviously, the net, I mean, even though the netbacks were lower, still your economies of scale are kicking in nicely. So there's that giving you great net back, still great netbacks given the prices were lower. But I'm going to start off with a few questions, and then most everything was addressed in the press release. If people want to dig in a little bit more, please feel free to put it, ask another question. But okay, on your drilling program, you've increased it now to 8 wells for the year. We've had now, and it's, the oil looks much more constructive than it did, let's even say 2 months ago. Your prices have gone down for drilling. Rig availability has increased. And given all these positives, why would you not accelerate drilling a little bit more?
Well, we're drilling here. What we announced is what we've announced. So we've announced the 8 wells. We've changed it to a continuous 5 wells already. And as time goes on, when we see fit that we can increase further, and we'll make that announcement and make that firm decision, then we'll make that announcement. Right now, what we do in the field is we try to set up things so that we have the options in order to increase that, and long lead items and things like that we try to take care of, so that accelerations can take place when and if we all deem it the right time to do so and to announce it.
Because you could lean into your balance sheet a little bit and then see the rewards second half, no? Or you've kind of modeled, I'm assuming, different scenarios.
We're not going to pull in a second rig. So we're drilling right now, and we'll get through these wells and get them online. And at some point in time, we'll give you a forward guidance on more than that.
Okay, so I guess we can expect probably, when can we expect updated guidance after these next Caney wells, or do you want to wait till the next 3-well pad and then change guidance?
I don't have a firm timeline on that. Let's just see how everything evolves, everything rolls out, and then we'll make changes.
Okay, and that was one done from the audience. And so let's talk about the wells that you just drilled with the T-zone, and how are they continuing to perform? I mean, obviously they were extremely good, and we're increasing, and the 30 well rates were good. And how are they hanging in?
Yeah, I mean, you'd expect them to go down the decline curves like they are. And so we'll see as time goes on. It hasn't been very long since we made our last announcement. So,
yes, I realize.
Give us some time.
It's been weeks, yeah.
I'm not going to put out press releases week by week on how these wells are doing. Right?
No,
we're going through a normal procedure in the oil and gas business, drilling wells, putting them on production. And we'll report it.
It seems so last month.
Adjustments.
Seems so last month. I can't, anyway. There's not a lot of things to ask, so I'm making shit up. Anyway, but they're hanging in all right. Now, I think one thing you might want to explain to some people, even though it is a shale play and there is still variability in the geological formation. So you're going to have some wells that do come on at 900 BOEs a day. But some that come out at 600, that doesn't change the quality of the reservoir. Yeah,
that's exactly right.
Yeah, so I think it's important for people to know that there is variability. But what's key for your formation is that you don't have like gas streaks, water streaks, which helps with your recoveries, ultimate recoveries.
Yeah. I mean, we have a homogeneous shale that's predominantly shale. We don't have, like you said, any high perm streaks or anything else that we drill into where you're worried about migration of oil and gas into it. It's all being generated in the Caney from everything we've seen, with maybe a little bit of migration in from the Woodford gas in some areas. But predominantly it's all there. And so across the field, you're going to have some areas that are a little bit higher porosity, a little lower porosity, that make little changes that really you can't see until you drill it. And so you have higher and lower rates, and across the field, it should average into a certain number, and that's what we were targeting.
Mm-hmm. Okay.
Not concerned at all. Let's put it that way.
Yeah, no, I'm not. But, some people who aren't as familiar with oil and gas do ask that question, right? I mean, this is very early on with the T zone, so it's hard to determine. How does this change your potential number of locations for the T zone, given the data that you have thus far, or is it just too early to tell?
It is too early to tell. I mean, I would anticipate that we'd have at least 2 to 3 wells per section that we can add for the T zone. That would be our guess, just because it's a little thinner than the Caney. So I wouldn't think that we could get to 6. And, I'm generally try to be conservative so we don't overpromise anything. So we just need some more time and it's going to take 5-6 months of production from a couple of T zone wells to figure out some of the stuff, just like it took a long time for the Caney to come along. Netherland Sewell will probably give us lower reserves at first until they see more evidence. And
as they always do.
Yeah, that's just how engineers work, right? So they don't want to be wrong and mislead. So, it'll take some time, but it's all going in the right direction. I'm very happy with what we're doing. And it hopefully will add a whole lot of wells to our program and a whole lot of reserves.
Yeah, I was touching on reserves. Again, early to tell, but can you kind of foresee how, you should get a good bump from your PUDs to your proven this year, I would think, given how much more well data you have.
Yeah, we'll definitely get a movement from the PUDs to the proved, and then hopefully we'll get an increase of we'll get some sort of increase, I'm sure, from the T-zone wells. It's just a matter of how much. So.
Okay, from the audience, thanks for a wonderful quarter. Have the 300 BOEs a day of production that was either shut in or was in the process of dewatering after being impacted by the completion operations been returned to the current production rates? Second, should we anticipate similar rates shut in as the newly drilled wells come online over the next 6 months?
Yeah,
I mean, you have to do that. That's just
yeah, so no, that's fine. So all the wells are back on production that were shut in. Some of them are dewatering, so they're not up to the full rates yet. And we're going to do a couple things a little different on the offset wells on this one in order to try to minimize the time that's needed for getting the production back up to full production that hopefully they all come back to.
So the production you had shut in during the second quarter, that was when you were completing the 3-well pads, just to make sure there was no communication, etc.
Yeah, what you do is you shut in the wells to build up a little bit of pressure, so your frac jobs stay closer and they don't try to preferentially go toward a well that's producing. Okay. So that's really, and like I said, that's where we're changing things a little bit. We will have shut-in times for sure on offset wells. We only impacted 2 of the wells, which was good, even though we shut in like 5 or 6, just to be careful. But they're direct offsets, so they have to be dewatered here, and then, like I said, they'll come back up, and hopefully the next ones will come up a little faster with what we're going to do this time a little bit differently. In the past, what we've done has worked really well. With this being a little closer, had a little bit more of an impact. So we're going to change things up a little bit.
Okay, so we could see a lot of different changes over the next little while as you now. Given that many of you, this is from the audience, given that many of your peers in the oil and gas industry have moved to longer lateral lengths and more fracks, when do you think it's appropriate for Kolibri to consider trialing similar methodologies if there isn't an appropriate time in your mind? Why not?
So we have fairly steep dips out here, so we take more risks if we're drilling longer laterals, and also how the field was set up. It makes it a little harder to efficiently get to all corners. So if we start drilling 2-mile laterals, we're going to have some parts of the field, because of faults that run through it everywhere else, that you suddenly have a half-mile well that you would be stuck with. So we are looking at some longer laterals, but right now, what's made the most sense for the development that we're doing is the 1-mile laterals. So it doesn't take any extra risk, and it will accomplish to hit all the corners of the field that we're looking to extract oil and gas from.
Okay. Do you want to show us on the map where you're drilling the next 3-well pad?
Sure. It'll be right down here in the east half of section 17.
Right. So is there anything that we can expect to learn from that that's new, or just infill, really?
Yeah, it's just that's all. I mean, it's offsetting wells. It's in the heart of the field. It's everywhere in the core here that we're looking to develop and where all our approved reserves are.
Yeah. So nothing new and exciting we could learn from that, except for except for on the T. Okay. One question. Your production guidance is 3,600 to 4,000 BOEs a day. You're basically at that right now. You won't tell me, but I mean,
we haven't changed the guidance, so you can assume that we think we're going to be in that range still, and it's going to depend on the next wells as they come on, right?
If they come
in like expected, then everything's good, and timing wise and everything else. If they're less, then it would be less. If they're far higher, then they would be higher. That's all I can say.
It's very glib. Very glib.
it's just the data that we have. That's all we can speak to.
I know. I mean, you said you'd exit between 4,500 and 5,000. That looks light if everything is successful, like quite successful. Like very light, but who knows, right? Like anything could go wrong. It's the oil and gas industry.
I mean, where we are in this field is these wells are making material difference that we're bringing on, right? So once we have more wells drilled next year, suddenly each well doesn't move the needle as far, and you can have an easier time forecasting. That's really what it comes down to, right? There are material that are coming on every quarter here.
Well, this is it. I mean, it's on a percentage basis, a big chunk of your production, right? So, the more production you add, the less material each well becomes.
Yeah. And how do you, oops, just flipping through here. I mean, if you look at the variability, right? So if you happen to drill wells like this that suddenly turn, our production's going to be higher. If you start having wells that come in more on the lower end, then it's going to be lower, and that's the material difference.
Yeah. Yeah, no, I mean, there's just, again, it's
that's why we pick the average. Yeah.
Yeah.
It's a numbers game. It's a numbers game when you're drilling oil and gas, right? Some are a little better, some are a little worse. And it's a matter of timing when those come in. So that's why we're comfortable with what we put out there so far.
Okay. Are the 6 wells per section just for the Caney zone?
Yes, that is correct. It does not include the T zone.
And if WTI averages $90 per barrel in 2024, do you expect to have a 10 to 12 well drilling program next year?
If everything goes well, then I would expect us to increase the drilling program. If we drilled 8 this year, then yeah, that's not inconceivable. So, but like I said, we'll put that out when we put a forecast out later on this year for 2024.
Now back, you said you're still having some dewatering happening on some of your wells?
Yeah, on the direct offsets.
Okay.
Yeah, and I mean the wells we've fracked as well. I mean, they're still producing water back. It just takes a while for them to get all the frack fluid out that they're going to give up. Yeah, it's not going to. Yeah. It doesn't generally change. It doesn't increase the oil production at this point. It's just the natural evolution of it.
Yeah. And how are we progressing on the two? So you're drilling the first Caney right now, and should be done very quickly, I would assume.
Yeah, everything's moving along.
Okay. Okay, and I'll ask something from the audience. Great job on execution to the team. Care to comment on the company's current valuation compared to your peers?
I still think we're too low. I think we're showing that we can convert these reserves into PDPs, and I don't think the market's valuing on proved reserves yet. So, but we keep doing what we're doing. We should get there, and then that gap should hopefully narrow. So that's our plan. Drill wells, execute well, get production going up, showing that we continue to have great netbacks, and that should shrink that differential.
I mean, you have a nice. I think we're up a lot today. But what I think, again, the issue is, it's still an under followed story. It's increasing. The exposure is increasing. And that said, more data, the more data you have, the more people are paying attention to what you're doing. So, right.
Yeah.
When you
No, that's
only
right.
had a few wells into the play, people were very skeptical. Now that, there's a lot more believers starting to take a look. Let's see, what else did I have? So no problem getting equipment, I'm assuming, given what I see.
No, everything's been good. I mean, we knock on wood, we've been fairly successful in not having to wait too long for equipment, even when times have been tight. We're kind of in the centralized area of Oklahoma, so it's nice. We can pull up from Texas, or we can pull down from the northern parts of Oklahoma, and that's worked fairly well over the years. So hopefully that continues, and I don't see why it shouldn't.
Okay. I don't have anything else, to be perfectly honest with you. Is there anything I missed?
No, I don't think so. So I think we're good. And if that's all the questions from the chat side, I tried to see those, but that was causing the feedback. So I can't see the questions either. So
no, there's no more questions on the from the public. So
all right. Well, good.
I don't really have much else to.
Yeah.
If anyone thinks of anything, feel free to email me at jessica@adcap.ca, or if you'd like to meet the company, happy to arrange. But other than that, great job, guys, and keep up the good work. And we'll look forward to another update in about 30 days or so, I would suspect.
Yeah, as things happen, we'll put it out there once we can speak to it. So when we have
another question's popped up here. Just one sec. Oh, great work, everyone.
Oh, thanks.
Yeah.
Thanks. Yeah, our team deserves a lot of credit. So it's all a team effort.
Yeah. Okay, great. Awesome.
Right. Thanks, everybody. Appreciate everyone for listening.
Thank you.
Okay, have a great afternoon.
Thanks, Jessica.